entitled Innovation, Technology, Policy, and Financing Schemes. I'm Cleo Kawaki. I have the honor of being the chair of this session. We have two women here. That's amazing, no? 480. Keeping it light. Okay, so last session. So without further ado, may I introduce Mr. Vishnoy, Managing Director by Sala Company, on the performance of operational wind energy projects in India compared to pre-construction estimates. We'll do a presentation, take a couple of questions, and then go on to the next one. We'll probably have time at the end for more questions, but we want to keep it so that everyone has a chance to do their presentation, if that's all right with you.
Actually, just a quick clarification, I think, so the designation is not managing director, it's I manage the sales, maybe they forgot to update, no problem.
Okay, well, you look like a managing director, so
thank you.
There you go.
Basically, the top, forget it was the presentation title is a bit long, but what we are trying to do is, I'll be showing you the actual generation values that we have seen for projects versus what had been estimated prior to establishing the project. And through that, I'll be also talking about certain risks that we have found are inherent to wind power projects, and possibly countries where wind power is just starting to pick up, they can take away some of the factors and maybe make some mending terms. So a quick overview about our company. Vesara is present worldwide, and here in the Philippines we do some work for all the airports as well as the med department. We provide quite a lot of weather sensors throughout industry, be it defense, aviation. Particularly, you might have heard more about 3-tier, which is the renewable energy arm of Vesara, and through which we do a lot of wind and solar assessments services. So I'll be talking about certain risk factors which are inherent to wind power projects. I'm limiting myself to these 5, and I'll be talking with respect to each case. This graph actually shows the pre-construction estimate, and this graph is for projects which were done before 2010. So wind industry was still a bit nascent at that particular point of time. And what we have over here is the blue line shows the pre-construction estimate of capacity utilization factor for wind power plants, and the red line shows the actual generation after the plants were established. So we see a certain gap. We see that most of the projects underproduced quite a lot. But actually, the first 2 projects, if you look at the first 2 projects, the reason why they underperformed was grid availability. And curtailment is something that we heard quite a lot about yesterday as well, and that is a ubiquitous issue to all these Southeast Asian and South Asian countries. So barring those 2 projects, the other projects were a reason of preliminary studies which were done at a point of time where the advancement in wind risk assessment was not there. They were done using simpler studies. This is a comparison of projects which have been put up after 2010, when a lot of complex models for wind resource assessments came into picture. And in fact, TNB also presented a similar analysis in American Wind Energy Association conference, and what we saw over there is that after 2010, a lot of complex models came in, and the pre-construction estimate became much better compared to what was being done earlier. In this graph, what we have is the middle line is the line which shows actual prediction. So if it's 100%, that means plants did produce what they were supposed to produce in pre-construction estimate. If it falls on the left-hand side, that means there was a certain bias, they underproduced. If it's on the right-hand side, that means they overproduced, which is a good thing. But more or less, compared to the earlier graph, people have become more accurate in predicting the actual generation of the plants. This is a much larger database. Sorry, I forgot to mention that is only for Indian power plants, and this for each bracket over here is 1 wind farm year. So that means if we have 8 wind farms and we are using each year as a reference point over here. Similarly, in this graph, each particular bracket reference, each particular block rather, pertains to 1 wind farm year. And this is a much larger study, so this is a comparison between the US wind farms. So we can see what happened in India versus what is happening in the US, and the graphs are largely similar. The middle red line shows the deviation versus the actual implementation. On an average, we see a bias of just 0.1%, but that is on an average. Otherwise, we see a normal distribution, and there are certain wind farms or certain wind farm years where the plant has under or overproduced compared to what it was supposed to. Now, what would be the ideal scenario? The ideal scenario would be that this graph is very narrow. That means all the plants are producing what they are expected to produce. But that is unfortunately something which can never happen. Maybe it can become a little narrow with some ongoing studies which are going on, but not exactly narrow. And the reason is annual variation. Nobody can control the annual variation that will happen in a wind farm. And actually, I'd like to show that with a case study of an actual project in India. So generally in industry, banks and developers expect you to have 1 year of mass data. That is the minimum. And if you have 2 years of mass data, that is very, very good. In this particular case, we had 3 years of mass data with a particular client. And they were very happy because they were seeing an average wind speed of over 9 meters per second. They went ahead with this data and installed a project over there. Once they installed the project, this is the wind speed that they saw for the next 3 years. You see a significant drop. It's going till 8 meters per second. That is when they came back to us and they asked us, what is happening at our side when we installed the plants. When we had a different projection, we were thinking that we will get 9 meters per second, but now it's getting 8 meters per second. So what we do is, we did an historical graph return for that particular site. We studied that site and studied the wind flow pattern at that particular site for last several years. This is what we see. Incidentally, those 3 years was the best 3 years in the entire history for that particular site. And that's pure hard luck for a developer. But what they were seeing was 8 meters per second. That was also not the true picture. So they didn't break that much. The average wind speed at the particular site was slightly below 9. And when we waited and we saw what happened in the future, you see wind speed went back, and that is returned to more of the average pattern over there. So this is the annual variability for which developers and banks need to be aware of, that not every year you will get the generation which is shown in pre-construction estimate, and there's a range which is there. So this is actually a graph which shows that how much wind energy deviated, and I have this from April 2015 to March 2016 because the financial year in India starts from 1 April. So that is the reason for that. The blue color shows lesser wind speed, and the reddish and orange color shows higher wind speed. And this has been developed from 3 different databases. So one is MERA, which is NASA database, and then we have EUCMWF based data called ERA, and then there is NNER database. Almost all of them predict that for the last financial year in India, the wind was on the lower side. And we also did some back-end analysis for our projects and communicated to the projects, and we find that the MERA is probably a more realistic map for this particular year in India. And still we see, okay, there is a certain pocket in the northern western part of India which has slightly reddish color, which means the generation was more than what was expected, but largely it's blue, which shows the generation was lesser. Now as a large developer or as a bank, what can I do about this? If my plant is located at a particular region, I can't really do much about it. But let's say if I diversify my portfolio, if I put my projects throughout the country, that way, yes, some of my projects will underperform, but some of them will overperform. And actually, you don't have to restrict to the country. You can move out of the country. You can probably put up some projects in Philippines. You can put up some projects in Vietnam, and that way you further diversify. And actually, you don't even need to restrict yourself to wind. You can probably also do it for solar as well. That way, you further diversify. And what would happen is actually wind and solar work very well. They are very complementary in nature. Let's say if it's raining quite a lot, then you would have lesser solar generation, but the wind generation will probably be higher. So that way they complement each other really well. So these were the risk factors that I talked to you in the beginning, and I've covered the first 4. First was the external factor, which was on the curtailment. Second, I was talking about the ongoing process of learning in terms of pre-construction estimate and what is happening in the industry. Sorry. And then we talked about the annual variability with the case study. Then I was talking to you about portfolio. And last is future wind turbines. Now this is a tricky one. What happens is, let's say you put up a plant, and let's say 2 years down the lane, somebody puts up a wind power plant not too far away from your power plant in the predominant direction of the wind. That is really something that you cannot control. But what you could probably do is you could do a lot of research, you could identify future wind sites, and this is actually something that we are seeing banks and developers in India have started doing. They come up with a hypothetical scenario that in future wind turbines will come up at certain locations and after certain years, and they have started to take that into account. But this is a very tricky aspect that people should be aware of. So actually I'm almost through my time as well, and we have to answer any questions after the presentation. Actually, and the organization have managed the presentation really well, because I was talking about wind and Ronald will be talking about solar and similar concept about risk. So yeah, thanks.
Any burning questions? Okay. No. Okay. So please keep them until the end of the presentation if you like. So can we go on to Mr. Satrawan, Senior Risk Analyst, Munich Re, Long-Term Risk Transfer Solutions to support and enable project finance for solar parks.
Yeah, good afternoon, ladies and gentlemen. Thanks for the introduction. So I'm Ronald Sastron, and I'm happy to be here to also contribute the point of view of a reinsurance company to this topic. So we are looking at non-traditional risk transfer to support and enable project finance. We also want to provide a long-term risk transfer, so not annual insurance covers, but maybe up to 10 or 15 or even 20 years. So first I would like to introduce our department, Green Tech Solutions, within Munich Re. So Munich Re is the largest reinsurance company in the world. We have a long history since 1880, large revenue last year, 2015, of 50 billion euro. We do also, instead of only reinsurance, we are active in all kinds of primary insurance, health and asset management, in all lines of business which are known as insurance. And we have a very stable result and a very strong rating. So in this large company, our team is called Green Tech Solutions, and we focus on non-traditional risk transfer, which are focused on the solar industry, the wind industry, and also energy savings such as LED, biomass, waste to energy, also energy storage, lithium-ion batteries. So all these risk transfer solutions, they are more or less from the idea very common, very similar to each other, but today I will talk about the solar solution. However, in wind and also lithium-ion batteries, we follow a very similar approach. So the solar park performance cover as beneficiaries or as insured the park owners, developers, and beneficiaries, the investors and the lenders. So we like to look first from a more general point of view into the risks in developing and operating solar parks. So if we start from the construction phase of the solar park, we have traditional insurance solutions. They are more or less mandatory, so construction all risk or erection all risk. And in the operational phase, we have comprehensive solutions. They are known sometimes as comprehensive machinery insurance, and they are all more or less mandatory and focus on covering physical damage, so external physical damage due to sudden loss, such as natural hazards, storm, earthquake, fire, and so on. And they are usually annual policies, so there's a renewal risk there. But so they are short term, and they also can pay a loss of revenue part, such as delay in startup or business interruption due to physical damage. So we analyze now the solar park a bit in more detail, so we can identify gaps in this traditional insurance. And here we see a simplified risk diagram of the solar park. The three main performance indicators are the park availability, the performance ratio, and the irradiation sum of the sun. If I multiply these three values, then I can also get the energy yield more or less directly. And when I then also know the feed-in tariff and the grid availability, I can calculate my revenue. So we see already two risks. Feed-in tariff obviously is a big political risk, delay in feed-in tariffs, grid availability, the curtailment in China. I must also disappoint you already, because these are risks we don't take as Munich Re. We focus on the technological risks, so we see that the park availability is threatened by physical damage mostly, but these are covered by traditional insurances. But we also see downtime of equipment due to non-physical damage. So this is more or less a bit insurance talk. Non-physical damage, we mean defects, internal damage, serial defects or degradation. So these inverters can go down, and then they will, due to downtime of inverters, reduce the park availability. Similarly, we can also have a degradation in the modules, and they will decrease the performance ratio. And then we have also in the performance ratio design risks of the solar park and O&M risk, maintenance issues such as soiling or shading. For the next performance indicator, irradiation of the sun, we have a weather risk. We also talked about the wind risk before. But I want to say that we don't want to take these O&M risks and the political risk, but we can focus on the largest risks due to availability. This is inverters and the modules. So from a risk analysis point of view, we try to put this in a kind of we say risk pyramid. So at the bottom of the risk pyramid is the most severe risk, the risk with the highest impact. Not necessarily the highest probability, but the highest impact. And if we have a high impact and low probability, then we go for insurance usually for risk mitigation. So the highest impact has for sure something that threatens the material assets of the park. So at the bottom we have physical damage to the equipment, such as earthquake or storm. But just immediately after that, our risk analysis shows we have non-physical damage to the equipment, for example, degradation of the modules. And then above this, in the light blue, we have a loss in revenue part. It can be business interruption due to political risks, or business interruption due to physical damage, also business interruption due to non-physical damage or maintenance issues. And maybe on top of the pyramid, we have something like lack of sun, since we can also cover it by insurance, but especially for solar, we have quite a good certainty in this measurement compared to wind, where we have seen just now it's more and more critical. So let's see how we address this, or how we see these risks in specifically for the modules. So we see here a very standard guarantee or a standard performance warranty of a module. This is more or less industry standard. It goes for 0 to 25 years on the x-axis, and it starts at 100%, and then it goes down by 0.7 per year. So this is actually something that evolved due to feed-in tariffs being guaranteed something like 25 years. It's an industry standard that every module manufacturer has to follow in order to be in business. However, from a technological point of view, we are not so sure. So the degradation remains uncertain. We have not enough field data actually for this technology. Accelerated aging tests are few, or actually only limited to some months or years. And then we have also a high cost pressure on the bill of materials. So we even see a nice study also from DNV who published this in the internet. We see the degradation rate, even for high quality data. The mean degradation rate shows something like 0.5, 0.6, which means there's also quite a lot of modules which degrade higher than 0.7 or even 1%. So we see here a large, almost 40% of the investment of the equipment assets are threatened by this uncertainty, especially if the module manufacturer is out of business. So this is where our insurance will focus its risk transfer on. We can actually cover module replacement under degradation if the module supplier is out of business. The same for inverters, and we could include also loss of revenue parts due to module downtime or due to inverter downtime. We could also include a part loss of revenue due to lack of sun. Now we want to talk actually but more only about this module replacement, since this we see from our risk analysis is the most severe risks for lenders providing non-recourse debt. So we think it's crucial that this equipment assets of the project are insured adequately and long term, and in event of the equipment supplier's default. So the way we actually do this is we mirror the the performance warranty of the solar modules. You can see the same graph. It only goes now maybe to 15 or 20 years, depending on the debt repayment period of the project. And then during that year, we mirror the performance warranty of the manufacturer, and we have two insurance triggers. So first is the insolvency of the module manufacturer, or the inability to warrant to honor the warranty. And so we collect all then the underperforming modules. These are the red dots. We collect them over the whole year, and once they go over, let's say, a serial loss trigger, such as 10%, which we can define, then we start paying out. But we pay out actually all 10%. So it's not a deductible, as we know from insurance, other insurances. We do it without deductible. It's a really strong policy, which has a trigger of serial loss trigger, and we can also offer limits. So the whole policy limit of up to 100% capacity, or 100% of the module value. So the risk transfer we do by a kind of insured level. This is this green line. We can see what is the investor really requiring. Maybe they don't require 100% of the performance, but only 95%, and we can follow the financial model here of this solar park. So in conclusion, this is, let me say, we offer here some kind of long-term risk transfer that mitigates risks that are not covered by traditional insurance. Since it's a new technology, we have also some new risks which we should address. And we see a lot of solar parks being built these days, but there are some risks, maybe they only show up in 10 or 15 years, especially if we see now other suppliers and developers going into default, and then these warranties are void, actually. And this is a severe risk which we mitigate here. So we have a long-term policy, as I said, it's non-cancelable, that makes it very strong. And we also need a strong policy because it's like an earthquake cover. You need also something that has no deductible, which we offer, and we can provide capacities up to 100% of the module price. It's also important that you don't have like a really weak cover here, because it's really concerning the material assets of your park. So this is a very strong policy with no deductible or self-insured retention. And no, let's say, no order waiting period. We start with the provisional acceptance of the park. And hope like that, we hope to improve the bankability of the park, and maybe in best case even improve financing terms. So thanks for your attention. And if you have questions, we can just have some of them now as we start.
From CTIB Fan. It's interesting that you have a policy which is not cancelable for 20 years, but how do you load the premium? Do you take it yearly, or it has to be paid upfront?
We take it upfront in terms of a percentage of the module price, and then it will is uncancelable starting for 15 or 20 years.
So it basically has to be more included in the overall cost of the project.
It has to be included, like more or less any insurance probably should be, but our premium will be a one-time premium.
Yes.
What we don't have is this renewal risk, which would make such a policy almost useless, because the risk starts actually is growing into the end. And if you already see some modules underperforming, then probably the renewal risk will be quite high.
Usually, what is the percentage that you charge?
I cannot now say any percentage, because we also adapt the risk transfer very according to the requirement of the investor by this insured level. This can almost be anything, let's say. But if you want to know more, then we can talk after this talk.
Thank you.
Are you basing your reimbursement in case of default on the present cost, or on the cost of at default time?
It's yes, actual cash value at the present when the module is being replaced. So we take into account depreciation. Probably the warranty of the manufacturer would also do this. Depends on the exact warranty.
Good afternoon. I'm Mary Ann from the University of the Philippines. I'm trying to develop a project which will consider the construction of elevated sky bike lanes for Metro Manila with solar panels on the roof. Your presentation is only for solar parks. Will you consider a project where it's going to be a Metro Manila-wide series of elevated bike lanes with solar panels on the roof?
Yeah. We can pool like several smaller projects into like one project, but the minimum size should not be smaller than like 8 or 10 megawatts.
Thank you.
What is the claim rate? You mentioned the risky areas and non-risky areas, so in what, where do they fall?
I mean, the claim rates, in historical claim rates, well, let's say the issue is that we have here that we don't have so many historical claims. We have some claims, but the policy has just started in most of our projects. We insure a lot of projects worldwide already, but the risk is now going up. We are at risk, but we don't have reached a time frame yet where we can say. From an insurance point of view, it makes it very difficult. We rely completely on our models, and we cannot rely on past claims here.
Okay, I have a question for you. Which markets in Asia do you cover?
Well, we cover actually worldwide. Let's say we have insured parks in US and Europe, a lot in Japan. We have insured in Thailand parks. It also depends sometimes on so we are able to cover everywhere with the primary insurance as a fronter, and we will reinsure this primary insurance. It depends a lot also on the risk management of the banks usually. So in some countries such as Europe, US, or Japan, the banks have quite a sophisticated risk management. So they see these risks which we have, which I described here, and they need a way to mitigate it. So insurance can only be one way. You can also have another mitigation way, such as maybe making reserves on your project or transferring the warranty to the EPC itself. But there has to be a way. Some banks demand that way. There are other countries and other banks where we think the risk management is not up to this level yet.
Thank you. So I think we've had Ronald standing up for a while now, so if we may go to the next presentation. If you have more questions for Ronald, we'll have a little bit of time at the end. So Mr. Goli, Chief Executive Officer of IPX Clean Tech Asia, and he'll be doing a presentation on accelerating the transfer of clean technologies into Asia. Thank you.
Thank you. Good afternoon, everyone. I'll be speaking today about IPX Clean Tech Asia, which is a clean tech focused technology matching, advisory, and deal facilitation firm targeting Asia and focusing on the transfer of already commercialized clean technologies into Asia. So I'll be speaking specifically about some of the technical, commercial, legal, and regulatory challenges associated with this. If I could summarize IPEX in one sentence, it is that we are a one-stop shop for clean technologies. The matching, advisory, and deal facilitation services that we provide to the technology providers, adopters, and project developers not just help create a bankable project, but help bank it. This basically means that the technology provider is able to monetize his technology in another jurisdiction, and the technology adopter or project developer has a de-risk solution which can be quickly deployed or technology transferred into his area. Now, of course, when you talk about the technology transfer value chain, this is something which has always been happening. I think the difference between IPEX and other service providers in this area is that IPEX provides all the services, the technical, legal, regulatory, financial services which are required to complete the transaction under one umbrella. This is different from the present scenario in which majority of the cases there'll be one company that does the matching, another company that does the advisory, another company that does the financing. And between coordinating all of these agencies, actually, a lot of the deals actually fall through the cracks and they don't go through to completion. So if we look at the first of all, I think we all here agree that that it's very clean technologies, low carbon technologies are very important for climate change in developing Asia. So let's take a step back and look into the various challenges of low carbon technologies transferred into developing Asia. So I think if we could categorize them, they would probably fall under three broad categories, which are technology challenges, legal challenges, and financial and commercial challenges. And all these three are like the pillars of a three-legged stool, and each of them needs to be strong, robust, and addressed in order for deals, for transactions of technology transfer to go through. Now, to expand a little bit on technology, technical challenges could include the fact that the adopter doesn't see a relevance between technology which has been commercialized, say, somewhere in Europe, and how it can be implemented here. They think it's too expensive. They think it cannot be localized. In terms of legal, the challenges could be the technology adopter is sort of wary of going into a new country or a new jurisdiction. He's not sure of his own IP protection. And in terms of financial and commercial, as we'll see on a later slide, there's a large percentage of these deals which don't actually go through. So the financiers are also somewhat skeptical about investing in these. So apart from having to address these challenges and having three robust pillars, this three-legged stool also rests on, if I could use the word, a platform of contextual relevance. And unlike the previous three issues, which could be addressed by the private sector, including IPEX, the contextual relevance platform includes things such as in developing countries, buyers are not willing to pay for an informed opinion or knowledge rather than more a product. Or it could include social and political challenges such as the inability, the unwillingness to phase out, say, wood burning because it affects and replace it with a clean technology because it affects the livelihood. So these are some of the things which need to be addressed not just by private organizations, but perhaps by private and organizations and the government. And NGOs together, and that's something which IPEX also has been working on both directly as well as through ADB. Next, if we look at the technology transfer ecosystem, there are probably 4 distinct pathways which result in the benefit of a technology to a target jurisdiction. And the first of these is probably the most basic, and that is the deployment of a new technology, deployment of a product or technology into a new application. The next one could be deployment of a technology or a sub-technology into some sort of a process plan. Now, both these are things which help develop a domestic demand for technology, which is very important before the remaining 2 phases. And so the services that are needed in this portion are typically the market development, technology customization, deal structuring, and local support. Once this domestic technology base is built up, then the IP transfer can take place in a much more de-risked manner, and investors will be more willing to come in. It could take place in 2 phases: license production, wherein the adopter is not willing to pay, is not confident of paying upfront for the entire technology, or if the technology provider wants to keep control over his technology for the time being. But eventually that is likely to lead to an IP sale wherein the technology adopter has the right to become an OEM himself. And for this, the majority of the services that are needed are probably on the legal and deal structuring and IP transfer side. So if we look at the now the next three slides, I'm going to be talking about the technological, geographical, and functional perspectives of technology transfer. If we can sort of put the various clean technology, low carbon technology areas into a few buckets. These are solar, energy storage, energy efficiency, water treatment, pollution control, and waste energy. And the key is not just to treat these as the end in themselves, but help them diffuse out into a variety of end-use sectors, which could be oil and gas, process, manufacturing, telecom, renewable energy, in such a way that they reduce the carbon footprint and do so sustainably from a financial standpoint. If we look at the served geographies, when we talk about commercialized technology transfer from, which has traditionally taken place from the developed geographies into developing geographies, I think some of the technical, commercial, legal, and regulatory hurdles I've spoken about already. But increasingly, we are putting a lot of emphasis in south-to-south cooperation. It's a very important area for ADB also. And this is important because not only does it keep a lot of the resources within the region, but if we're talking about from China to other parts of Asia, the technologies available within Asia might actually be more localized and to the context than something which might come from North America. Finally, we look at the third of these slides, we look at the suite of services that are needed for technology transfer. I think a McKinsey report, which came out a few years ago, which was sponsored by ADB, concluded that 80% of the deals don't go through because of the lack of proper wraparound services. And by that I mean the market development services, the technical, legal, financial due diligence, contract drafting support, and fundraising support. So it was critical that there was a company which went beyond just the matching and then provided these wraparound services, and not just in a cookie cutter approach, but in a customized approach, which is sort of depicted by the intermeshing pieces of the jigsaw out there. So in order to address that, what was needed was not another consulting company or M&A firm. What was needed was really a hybrid of the two, and this was what was visualized, which would be a preliminary screening from a legal, technical, and commercial standpoint, which would result in a bucket of, a database of available technologies. Then going through the actual matchmaking process between an adopter and a provider, which would include technical, business, and legal advice, which would typically be conducted on a retainer basis. And then going on to the actual brokerage and partner services, which is the contract drafting, negotiation support, the detailed feasibility study, right up to capital raising, which would result in deal closure, which was foreseen to be undertaken on a success fee basis. So it is in recognition of this need that IPEX was formed about in December 2014. We were created as a consortium between a technical partner, DNVGL, and a financial partner, VX Capital Asia, with initial seed funding from Asian Development Bank. So it was this structure that allowed us to keep us a very lean structure, yet draw upon the depth and breadth of expertise of our more established partners in these areas. In terms of operating structure, IPEX goes beyond just matching deals and creating deals. We aim to streamline the entire ecosystem, and so for this, we go much outside our tripartite agreement, and we work with a network of experts, external experts, as well as local, regional, and international partners, so as to provide this database of vetted technology suppliers and adopters, our core brokerage services, and additional services provided by our partners as needed to close the deal. So what this means for technology providers is that they can get market entry strategies. They have a more de-risked path into another jurisdiction, and they have IP protection among the other services listed out there. Similarly, for technology adopters, they have access to a vetted technology base, so they know that what they're getting will be suitable for their application. They also get a lot of deal structuring and legal support services, given that many of these are SMEs which might not have actually been in the space before. The next 3 slides are actually 3 almost case studies that on clients that we're working with right now. One is a mandate that we have from a technology provider, which is actually an Italian smart street lighting company. In the first phase, we located the areas that they would focus on. In the second phase, we acted as an accelerator and found specific opportunities, and then we leveraged our network of partners to find the decision makers among those opportunities, and we expect to close at least 2 deals in the coming months, along with all the support services that I mentioned on the previous page. Second is an technology adopter-driven mandate, in which we were engaged by an Indian water EPC to find them 2 technologies and then help incorporate those technologies into projects which they could execute in India. And the third one is focusing on the South-to-South cooperation that I had mentioned. We've signed an MOU with a China-based provider of solar technology, and we will help them in finding the right technology adopters in the rest of Asia and provide the services critical for streamlined deal facilitation. So to sum up, last slide, why Apex Cleantech Asia? We're a one-stop shop for technology transfer. We don't just stop at matching matching 2 technologies and collecting our fee and leaving. We get our fee when the whole deal is concluded, and that adds to not just our own credibility, but also the credibility of the tech transfer ecosystem as a whole. We're dedicated to clean technologies and deployment in Asia, so our entire depth and breadth of experience is focused on this very narrow niche area, so high concentration. We have support from ADB, which not only has is giving us a chance to establish ourselves commercially, but also opens the doors to many opportunities in the region. We're backed by very strong partners, as we saw in a previous slide, and our extended partnerships across Asia and beyond give us on the ground, boots on the ground presence in all these areas. Thank you.
Any questions? I'm sorry, Mr. Gole, I forgot to tell you, you went overtime, so you have to buy everyone beers.
6 o'clock in the cafeteria.
Okay, free, I guess. Okay, so okay, one question, how much do you charge?
So that depends upon the case, but like I said, the key elements of how we work is a retainer fee to make sure that all the parties actually have some skin in the game, and that actually does not cover all our costs. We are incentivized by the success fee, which we accrue when the deal closes, and by charging the success fee approach, we actually reduce the risk on the project, because should the project fizzle out, the project is not liable for any costs.
Good. Right. So shall we go on to the next one? Thank you, Mr. Miller. Okay, Mr. Diol, Chief Executive Officer, My Energy Renewables, with the presentation Accelerating Adoption of Rooftop Solar PV in India Through Project Aggregation.
Thank you. Well, now that it seems like I'm the last person, or almost the last person standing between everyone and their beers, I'll try to be brief. I'm Bhaskar with My Energy Renewables, and the topic of my presentation today, which is a bit of a mouthful, is really how to accelerate adoption of rooftop PV through aggregating projects in India. And just to lay out the structure of my presentation, I'll start off with a very quick sort of an overview of where we are in the Indian market, sort of what's the opportunity like, and just put that in perspective. And then talk a little bit about what's the policy landscape, what are all the things that are in place that have sort of helped us get to where we are. And also then through that sort of talk a little bit about what are the challenges for the next phase, and where we are planning to go. And then I'll end my presentation just talking a little bit about 2 possible structures that could be used to aggregate solar PV, and that could be a way forward. But by no means are the only 2 possible ways. There could be other models, and that has been the experience in other countries. And then, of course, what actually turns out, we have yet to see. So just to kind of put this in perspective, India has a huge solar PV potential. We've now already, I think we're somewhere between 7th and 8th largest installed solar PV capacity. and install about 7.5 gigawatts. But that's only 1% of what's the assessed maximum potential of the industry. So almost 750 gigawatts. That's been one of the analysis that's been put out. So clearly, there's a huge potential, and it can be met, and it can really help accelerate the low carbon energy development in India. The country has set itself very ambitious policy targets. So 100 gigawatts of solar PV by 2022, which underpins India's commitment under the Paris Agreement at the COP, and really also, like I said, the fundamental driver for this transition. Where we've got to today has been a result of really good work being done on the ground by the policymakers. And we have a suite of policy measures, instruments, incentives that are in place right now that have been, that have helped the country sort of reach the stage. For example, renewable purchase obligations, which are in place on states, tariffs and incentives, which again sort of depend on which sector. So looking at wind as well as solar PV, tax exemptions, accelerated depreciation, for example, which has been a big driver for the wind industry in India and also the solar industry in India. And state-level policies, states have really come up to speed in the last couple of years and are now taking sort of front leadership in driving this forward. And then lastly, a number of agencies, including multilateral agencies such as ADB, World Bank, and others providing credit facilities, and so on and so forth. And but in spite of all that, the deployment that the industry has seen in the solar sector has been a little bit of lopsided sort of growth, and particularly on the grid-connected large megawatt scale, we've seen a strong adoption. But that's not been the case in other areas. For example, if you look at rooftop solar PV, which has been a major driver in other countries, that has sort of fallen behind a little bit, and that's what I'm going to be focusing on. And there have been a couple of analyses in the recent years which talk about the real risk that the country now has of possibly undershooting our 40 gigawatts of target if a lot of aggressive measures are not taken. So just to now take a step back, how have other nations solved this problem? And fundamentally there have been sort of two approaches of getting to more solar PV on rooftops. One is sort of a utility-driven approach, and the other is sort of a consumer-driven approach. And both of these have been tried out in India. And just to give you a quick example, in case of a utility-driven system, you will probably have the utility being the driver and either owning or facilitating installation of a system on a rooftop, and then generated electricity obviously is being consumed by a consumer or is fed back into the grid. And this has been tried out in the city of Gandhinagar in India, but somehow that's not really scaled as much as it may have. And the other example is consumer-driven rooftop, which appears to be more possible, but at the same time is far from sort of being the proven model right now. And in the case of this, you may have sort of a third party or an investor owning the asset on the rooftops, and then again, selling the power generated to the consumer and so on. And here again, there are examples. So Tata Power, for instance, has worked in India with consumers, sort of, just helping to do that. And so just the challenges to lay out, what are some of the barriers that are, standing in the way right now for this sector, and there's a long list. First of all, there's still uncertainty about how the systems are going to perform, and I think we heard in the presentation earlier about solar parks, but I think the same uncertainty about performance of the system also applies to the smaller scale rooftop systems. There is still a severe dearth of financing options. If you are, as an end consumer, unable to find big financing support, then it's really a challenge. Capital costs, even though they've come down, they still remain a barrier. Third-party off-take risk, again, is an issue. And a number of potential solutions are also available. For example, the accelerated depreciation that I talked about earlier, innovative products that are now being discussed. So on balance, I would say a number of barriers outstanding, but at the same time, a lot of thinking and a lot of innovation around how these can be addressed. And I'm just going to take two examples of how aggregation has worked in the past. So the first one is the case in Gandhinagar, which was almost now about 4 years ago. And this is a simplified sort of a schematic supported by the International Finance Corporation, driven by Torrent Power, which is a utility in Gujarat. That basically bid out 2.5 megawatt each to two developers, who then found a number of rooftops either for residential customers or government offices to offtake this power, to basically sell this power. And so this was an interesting model. It was really a pilot, first of its kind in India, but however hasn't sort of replicated. The other is another model that's right now being pursued or sort of thought through in India right now, although it's far from sort of complete or executed, is sort of a larger warehousing and securitization sort of an approach, wherein there is a significantly large size fund that's put together that works with a number of developers across the country, and putting all these assets in sort of one warehouse and then helping them reach the financing goal that they have. And as I said, none of these approaches have yet sort of resulted into the market taking off, but that is the expectation. So whether it's one of these approaches or a third sort of an approach that ends up helping drive India towards getting to scale solar PV rooftop, that's sort of yet to be seen. But that's where a lot of the thinking would be in the coming years. So with that, I'll just end here and talk a little bit about Minergy. We're a platform specifically just put together to help bring the financiers and the customers, as well as the engineering companies and project developers together. So if any of you are interested in discussing this with us, we'd welcome to have a conversation on the sidelines, and happy to take any questions. So thanks.
Any questions? So you're saying this aggregation, these deals or the structures you mentioned, hasn't really taken off yet?
Well, as I said, the first example in Gandhinagar, that was executed 4 years ago, but it's not been replicated thereafter. The second one that I talked about is currently under development, and it may
Any analysis on why the one that was done 4 years ago hasn't been replicated?
Yeah, that's a great question. So specifically, the issue around that has been that the rooftops for offices and residences were sort of rented out, and somehow the economics of the solar PV, I mean, that was also a very significantly high tariff of almost 8.5 rupees. Because of the falling prices of PV, that's been a big reason why it's been difficult to replicate that.
Thank you. Okay. So for last but not least, Ms. Hawila. Sorry, Hawila, sorry, my apologies. The Associate Program Officer for International Renewable Energy Agency on Renewable Energy Auctions, a Guide to Design. Actually, I had someone from Kyrgyzstan, or no, Kazakhstan. We just wanted to know about this one. So.
Perfect, I hope they're here today. Hi, I'm Diala Hawila. I'm from IRENA, the International Renewable Energy Agency. We are an intergovernmental agency that supports governments in the deployment of renewable energy. I work in the policy unit, so we help in the design of renewable energy policies. Today we will be talking about auctions, but it doesn't mean that we only support auctions in the agency. So in this graph here, you can see some of other instruments that have been increasingly deployed over the years from 2005 to 2014, such as feed-in tariffs and premiums, RPOs, and auction-based. And as we can see in this figure, although all of them have been increasing, the rate of increase of auctions is higher in the past 5 years. And we will talk about the reasons why. But it doesn't mean that they are better than other instruments. And we see some countries that move from, for example, a feed-in tariff to an auction, such as South Africa or Brazil, while other countries move from auctions to feed-in tariffs, such as China. And there are other countries that use them in conjunction, such as Germany and France. For example, in France, they have noticed that large-scale projects can work with auctions, while projects smaller than 250, for example, kilowatts will still remain on feed-in tariffs. And it's not the one policy that's going to solve all the issues, it's the way we design them and we combine them together. So we have been working on auctions since 2013, and we have noticed in 2013 that auctions were mainly adopted by developing countries. But now we have seen some other developed countries moving towards auctions, such as Germany, for example. And one of the reasons is to find the real price of energy from renewables and to decrease the cost of support. So last year we published a guidebook that helps policymakers in the design of auctions. It is made out of 6 volumes, and today what I will be discussing is from this publication. It is available online and it can be downloaded for free. So, as I said, auctions are not only the good policy, but they have some strengths and some weaknesses, such as all policies. So what are auctions? They are when the government tenders a renewable energy project, and when the project developer is selected, there's a contract that is signed with a PPA for 20 years or less, whatever the PPA says. So some of the strengths of auctions is that they are flexible in their design, and they can cater to any country-specific context, macroeconomically, level of deployment of renewables, and whatever context they are in. They allow for real price discovery, and this is only specifically when project developers are not underbidding. They provide greater certainty regarding prices and quantities, because we can award a project at a certain price and we can limit the volume of kilowatt hours, for example, we are buying at this price. They allow for commitments and for a good amount of commitment and transparency from both sides, the government and the project developers. However, some of the weaknesses associated with auctions is that they are associated with relatively high transaction costs, both for the auctioneer and the developer. And we see some small project developers sometimes have problems participating in auctions because they require a lot of high cost at the beginning. And also auctioneers have to design the auction, have to evaluate a large number of bids, so there's a certain cost associated with it. And there's always the risk of underbuilding and delays that come from projects, especially when there's a lot of competition and project developers are competing with low prices, as we are seeing today. There's this uncertainty that these low prices are going to guarantee feasible for the project developers and that are going to come to fruition. So the most recent highlights we have seen in wind and solar, we have seen remarkably low prices lately. The latest one is the Dubai auction of PV solar plant of 800 megawatts that resulted in $2.99 cent per kilowatt hour. In some countries we see higher prices, but they are still low according to that country. So it doesn't really make sense for us to compare prices in different countries. We're not comparing apple to apple, but we see that there is a lot of changes that are happening lately. And some countries, for example, Japan is considering moving from feed-in tariff to auction. And we have seen Latin America some very low prices, and in North Africa we have seen very low prices for wind, reaching even 3 US cents per kilowatt hour. So these design elements that we worked on, we combined them into 4 categories. And the first one is the auction demand, where we specify what are we auctioning, the volume auctioned, for example, what technology it is. And then the second category is the qualification requirement. How are we going to qualify bidders who can bid? And then the third one is the selection process. What's the process for them to bid? What's the selection criteria? How are we evaluating? And after the selected winner wins, on what basis are we paying them? Is it to pay as bid, or is it a uniform price? And there's the seller's liabilities, which are very important, such as the risks that the bidder goes through, the penalties and compliance rules. So there are key considerations in designing and implementing auctions. For them to be effective, first of all, we have to increase the competition between bidders so that we get the cost efficiency we are looking at. At the same time, we need to limit the participation to bidders who will truly meet the goals, and we have to do that while ensuring global and local socioeconomic goals are met. So we will discuss those very quickly. So increasing competition happens by diversifying, for example, the technology. This way we find out what is the best cost-effective technology in a country. We implement a technology-specific auction when we want a certain technology to be pushed in a country for so many reasons. Volume auctions, the larger the volume, the less competition we have. For example, in South Africa, when they auctioned the first volume, it was too large, they didn't see competition, they started shredding it into smaller volumes, and we saw higher competition and lower prices. We increase the competition by increasing, of course, the level of participating bidders, and we do that by reducing the risk that the project developer might face. Another one is by reducing compliance rules. For example, if the government can provide the resource assessment, a site selection, the site selected, then it encourages bidders to bid. And of course, there are design elements that are meant to prevent collusion, that prevent bidders from talking to each other and keeping prices high. Now, at the same time, we are doing this while limiting the participation to those who will truly deliver. And we do that by looking at reputation requirements, such as proof that they have done something before like this, financial requirements, and so forth. We do that by imposing compliance rules, bid bonds at the end to make sure that the contract will be signed, and then penalties for delays and underbidding, or for overperformance even, as we see in some countries. We also can impose some qualification rules to make sure that our deployment goals are met. And those are, for example, enforcing a certain technology. Project size requirements are important. If we give a minimum size, we enable economies of scale and lower prices. A maximum size, we can do that to enable participation of small players. Location constraints are very important to make sure that we don't overlap with other industries such as tourism or agriculture. Grid access requirements are proving to be more and more important these days because we don't want to overload the grid in one place. Socioeconomic impacts are also, we can add those in the requirements of a bidder, for example, local content requirements, or we can impose that we want to create a certain number of local jobs. We can do this either by including it as a requirement to bid, or in the selection criteria by putting it as a score and scoring the bidders. So we at IRENA, we do a lot of work on socioeconomic benefits of renewable energy, and our latest report that was launched last month shows that there are currently 8.1 million people employed in the sector. And so finally, the conclusions are, while designing auctions, we need to account for so many trade-offs between participating bidders with the competition and then making sure that the projects do come online. And there are different policy options to support deployment that are not exclusive. As we saw, we can use more than one together. But in any case, if we go for an auction, we need to tailor to the specific conditions of the country. Thank you very much.
Okay, any questions? Go back up. Try to get to the microphone.
My name is Shruti, and I'm from the Central Power Sector Regulator in India. So you might be aware we are having this debate in India because we have been discovering lower and lower tariffs in our solar auctions. The most recent one was around 6 cents. So there are EPC players coming to the regulator saying that we'll be left with like non-performing assets and we shouldn't really let this happen. But from the government or regulator's perspective, if the industry is undercutting, I mean, there's no one forcing the industry to go so low. So what can the government or the regulator do in such a case?
In the worst case scenario, the government, as it puts a higher cap, can put a lower cap to make sure that you don't have any underbidding.
But sorry to interrupt, but the point here is that regulator has, there's the information asymmetry, you know. As a regulator, the toughest thing is data. Industry is not really going to be forthcoming with all the real data in terms of their costs. So in fact, CERC does set some benchmark tariffs for the states to have some benchmark, and they're usually so off from the market bids that CERC is always criticized for the same. So I think the regulator is not in a rapidly evolving industry. The regulator is not in a good position to kind of have that visibility to how the costs are coming down. So I don't know, it's just a very catch-22 kind of situation where at least the Indian regulator is finding itself.
Yeah, so it's always about the combination of design elements. If your main, and of course they need to serve the goal of the government. So if the goal is to get the lowest prices and make sure that the projects will happen, then you can do that with imposing compliance rules of underperformance and penalties, and that way you can make sure that if the prices go low, even no matter how low they go, as long as the project is being delivered, then it answers the goal of the government. It's not a one case by case. Thank you.
Hi, over here. I had a comment actually, which was just building upon Julie's comment earlier. In the case of, you talked a little bit about resource assessment and that being something that can help lower barriers to entry, but there are sort of two cautionary examples in the Indian context. First one was when the National Solar Mission was just started, specifically for the CSP sector. The government basically said you could use NASA data, and a lot of the developers, being an early stage in the industry development, they took that DNI data for face value, and then realized that when they'd gone ahead and planned their projects around that, and the projects came out, they were significantly underperforming. So there's a little bit of that risk that the government sort of has, or the policymaker has, when providing too much information, because it has to come with sort of the statutory disclaimers or whatever.
Yeah, thank you. Yes, it's always a learning by doing process, and we keep on learning as we go along. So this is one example where it was a bit risky, and we see other examples where it was also risky, but it didn't have this this big risk element. For example, in China and Morocco, they were site-specific, but we didn't see this main problem. There's always lessons we can learn. Thank you.
Any other question? Great. Thank you very much. So any questions that you would have for any of the speakers, please, that you didn't get a chance to right after the presentation, please go ahead. Can you get the mic?
I have a question for Mr. Sastrawan from Degree. This kind of product looks very good. I think we're very, very popular with it. But do you also use this for other technologies, or would you consider using it for other technologies if yes, which ones? And particularly, let's say when it comes to certain types of energy efficiency projects, that maybe where the savings are also very predictable. Is that and it's also linked to equipment, that if there's failure, basically it compromises the financing. Are those categories that you are currently doing, other groups within Degree, or that you might consider in the future?
Yeah, first of all, thanks for this question. We are in the Green Tech Solutions team, so we actually do also apply similar structures to other technologies. They are not exactly the same, but the idea is always the same. We want to take a technology risk, such as long-term stability or performance, and then probably couple it with a credit risk from the supplier, or we also cover the supplier himself or herself, and then we do this for wind, obviously. We do it for biomass and for batteries. We also have insurances or products for the LED. This is what for our department goes under the energy efficiency name. So we are also looking into a kind of energy saving coverage, but it would go one step beyond. So first of all, we focus on the LED itself, or the luminaire where the LED is inside. And then if there's like large projects, for example, one city or one large autobahn highway, then we can look into similar structures like this.
I also have a question for Ronald. On your slide, I saw that you were saying mean module degradation is about 0.5 to 0.6% in a year. So that's great to know because that's kind of the benchmark we use in our tariff calculations also. But I just wanted to know what kind of data has been used to arrive at that figure. Like,
yeah, so actually this was from a publication from DNVGL. In my slides there's the internet link where you can download this publication, but actually they quote a publication which is called Compendium of Degradation Rates. It was published in February now, 2016, and they analyzed about 10,000 published degradation rates. And this is called Progress in Photovoltaics publication.
so in India, actually, the developers are overloading their projects by like 20 to 30% to counter this degradation over the lifetime. I don't know if you're seeing that anywhere else, but that's what's happening in India.
Yeah, we see this average rate, but when we look at the average, then what concerns us is actually that the standard deviation is of course not zero, and we will find a lot of modules underperforming, especially at harsher climates.
Hi, Grant Hauber from ADB. I guess in looking at all of your sectors and all of your products, the great thing that we've heard is that we're getting more statistical data, better, at least a tighter distribution in most cases because of this data. And I was interested in just that last comment about the compendium of degradation rates. But I guess one of the mandates we are now under at ADB from our president is to innovate. And we have to look at newer technologies and push limits, yet at the same time try to achieve some sort of impactful scale. So do those two things mix? Can we look at, say, less proven technology, or what could we do to work with you to resolve those problems? It's just a general question.
Maybe I can say something for the solar. So in the solar sector, we see now warranties going to 30 years actually, and with even less degradation. And usually they use maybe double glass module technology. We also have a cooperation where we then also take this risk because it's a better module. They have like silicone between the glass, even EVA free. And this is a very nice technology. We are prepared to take this risk, but of course the customers know it's a good module, but since it's a new technology, there's still this hesitance of market acceptance. So I think sometimes here we try to be a business enabling risk taker. If this is there would be a way to call it.
Hello, my name is Harold Burton of the Norwegian Development Agency. Oh, sorry.
Want to answer the previous question?
Well, I just wanted to quickly jump in there. I also feel that in terms of innovation, there could be other slightly related areas where there could be such things. For example, earlier this week we had some very good discussions about the off-grid sort of mini-grid models or micro-grid models, where the innovation is sort of happening around the PV system and not at the system level itself. And for example, prepaid meters, which are kind of helping the business model evolve a little bit. I think that's another avenue where we can think about sort of putting together the technology which is now maturing, but then how can that be better deployed in the context where it makes the most sense and it helps sort of the adoption.
And from a policy perspective, there are two streams where you can push innovation. The first one is innovating in the design of the policy, and we see this a lot lately. You can mix policies together, you can be very innovative and creative in the way you design the policy. And the other stream is you can push for innovation and technology within the policy itself. For example, you can design a policy that is specific for innovative technologies, and this is how you push the technology.
In that case, that's where I become sympathetic with our regulator here, because you have to, it's almost like you're gambling on picking winners. So it would sound like you would have to have some sort of collaboration with the research, or at least maybe not quite new, but fairly mid-proven, but not totally commercial. You're at a certain stage, but how do you pick the winners and losers as a government agency? It's operating, it's trying to define parameters broad enough to be inclusive, but tight enough not to let just anything get through. So I don't know, it's kind of intangible.
Yeah, I heard it echoing a lot. You don't, not from the beginning, of course. And we saw that the feed-in tariff, for example, pushed a lot of innovation in renewable energy, because when the feed-in tariff was there, the technology wasn't this mature yet, and it pushed it forward. So yeah, it's a trade-off. Thank you.
The option is you get a grant component from ADB and pay off Munich Re and get insurance. Oh, sorry, we had the gentleman in the back.
Thanks a lot. It's Harold Berkland of Norwegian Development Agency. I can also confirm what was raised by ADB. I was working for the Norwegian energy regulator for many years. We tried also to do the balance of how much to support and without being criticized by our taxpayers to overly subsidize renewable energy developers. But my question was actually to Bhaskar, I think, from India. I used to work also in the Indian telecom sector some years ago. I remember the telecom regulator of India was imposing green telecom energy regulations. I was just curious if you know any updates, if that was enforced or was it merged towards the broader energy regulations of India, because all the telecom operators were then obliged to use some sort of self-supplied energy, most relevantly PV solar.
Yeah. So in terms of the telecom sector, what's happened is a number of remote locations where you have these BTS towers that are used for signaling, they've been heavily reliant on diesel. So one big driver for the telecom companies has been to just look at it because it makes economical sense. However, there's also been a number of barriers in terms of theft, in terms of poor maintenance, in terms of how these systems have performed. Having said that, now in terms of the policy that is still there, and I think most of the telecom companies have looked at it mainly because it's been driven by the economic interests there.
Actually, I forgot to introduce myself earlier. My name is Ingo Pohl. I work for South Pole Group from Switzerland, but operating around the world. And this is actually another instrument to the question by ADB. So we are operating also a performance guarantee facility that's funded by the Swiss government with 250 million Swiss francs. And what we can offer is kind of like a first loss coverage. Basically, I think Munich Re calculates with a very sharp pencil and has very good models because they need to return value to the shareholders, right? In our case, because this is climate finance, there's a certain willingness to take risk for innovation. For basically the express purpose is to take new technologies that are innovative. Like there's also a focus on smaller players. There needs to be a link to Switzerland, though this argument about export subsidy, of course, couldn't be made. We're hoping to be able to expand that. And then we're getting into this world of kind of like blended finance and allocation of risk depending on what are the objectives of the people behind it. In this case, we want to see innovation. And if we promote innovation and lose some money over it, that's actually okay.
Thank you. Gentleman in the back.
Rahul Walker, I just wanted to add to the answer for the previous question. I believe that the solar-related policies for telecom have not been enforced. It has been left or converted to just a recommendation, and it's up to individual companies to implement it. But to add to what Bhaskar mentioned, Indian telecom companies have been adopting actually energy storage in a big way, with or without solar or small wind, for reducing diesel. So in the last 18 months, companies like Reliance Jio, Airtel and Indus, they have deployed more than $500 million worth of lithium-ion batteries for cutting down on the diesel consumption.
Thank you. I have, if I may take the last question, is that okay? This is for is bigger better when in auction?
The nice thing about auction is that you can determine the size. For price-wise, sometimes we say yes, bigger is better. But what you want to do is you want to encourage the private sector and more companies, smaller companies, to enter the market. In this case, probably not really better because probably you want to start small sometimes as well.
The question I got from one of my clients is they wanted to do 10,000 megawatts of solar. Should they announce that little at a time, or should they just say to the market, I have 10,000 megawatts I want to do, and the first deal is?
It helps a lot when you announce the 10,000 because you give confidence to the market. They know that more is coming. They know that if they establish themselves, there's a lot of demand that's going to happen. But if you auction at the beginning all the 10,000 together, it's not very recommended. It's better to cut it off and to lay out a good plan that is very clear to the public. Then this is coming, next that's coming, and then.
Just to add to that, I think the experience in India has also been that if the auction is not well designed, then obviously bigger is not only not better, but it can actually be a risk. And in the case of at least one state, which I'm not going to name, there has been an auction which has been successful and has resulted into low bids, but then the projects haven't ended up coming online. So you can drive the price very aggressively, but then if the rest of the policies don't line up, if it's too difficult or onerous, then people may sort of fall on top of each other to sort of try to win it, but then in the end you don't end up with the projects materializing. So that's actually a very big risk in my view.
Thank you. I'll tell my clients that. Okay, it's coming to that time, so I'd like to thank all of the speakers and thank the audience for their very good questions. Give yourself a big hand.